And welcome back to America's Forum right here on Newsmax TV. I'm John Bachman.
And I'm J.D. Hayworth. Let's talk oil. Oil prices seeing a steady increase over the past few weeks, largely due to speculation on geopolitical events. The Russian annexation of Crimea, coupled with the continuing buildup of troops on Ukraine's border, has left many worried that a disruption of energy supplies is inevitable. On top of that, workers' protests in Libya and sabotage pipelines in Nigeria have only served to increase fears that oil demands will fail to be met in the upcoming months. So, what's the real story? We're joined now via Skype by the CEO of McAlvany Financial Group, David McAlvany. David, thank you so much for your time and welcome to America's Forum.
A pleasure to be back.
Now, David, are these growing fears justified, or is this the scenario that gets a lot of buildup but fails to really produce a rapid spike in oil prices?
Well, whether we see a rapid spike in oil prices, that remains to be seen, but we do expect to see something of a floor, and Russia certainly is clear on wanting a floor on oil prices. They need a floor on oil prices. So much of their economy is dependent on oil and gas revenues that below about $100, $105 a barrel, they're operating in the red, and they would prefer to operate in the black. What you really have with Sevastopol and the incursion into Crimea is the guarantee that they have a warm water port. Guaranteeing a warm water port is important if they're going to continue to sell arms to Iran. Why is that important? Well, if you continue to sell arms to Iran, you create that conflict between Iran and Saudi Arabia. You underscore the differences between Saudi Arabia and Iran, and thus you maintain an elevated oil price. So the fiscal picture for Russia is dependent on the ability of Russians to sell arms to Iran and basically keep things going, as it were, in the arms business. So there's more to the plot, I think, than just the oil price, but the oil price is clearly the critical variable to Russian solvency.
Well, David, we're sure that probably came up in the discussion recently with President Obama and King Abdullah talking about that exchange of weapons with Russia and Iran. But we have also talked here in the U.S. about these natural gas plants coming online and having the president sign these permits, getting them up and running. We know that's a ways off for any real impact here, but would that send a signal here to the markets that the United States is serious about increasing natural gas production? And if so, what would that do to the price?
Well, not only would that challenge the monopoly status that Russia has into Europe in terms of delivery of natural gas into that space, but as soon as we get LNG plants and the facilities to export those throughout the country, they're talking about better than half a dozen different facilities. We are then in a position to export not only to Asia, but to Europe. And that really does, again, break the monopoly status which groups like Gazprom have into Europe.
Well, pardon the pun, but let's drill down a little bit with Gazprom and what Russia does with oil, David. As I understand it, the Russian Federation supplies about 12% of the world's oil. Now, we've talked about sanctions before, and when we visited with you earlier, there was speculation about it. Now the sanctions are in place. As a result, do the Russians try to raise prices right now and hold it over the Europeans, or how do you see that dynamic developing?
Well, you know, the seasonality here it does not favor Russia, and it does favor us. I mean, if we were sitting in sort of December, January, then you'd be looking at far more demand coming into the pipeline, so to say, from Europe or to Europe from Russia. But we're coming into a season where there's going to be less natural demand for natural gas for heating and whatnot. So we're losing some seasonal advantage, or the Russians are losing seasonal advantage, and we're gaining it. So I think when you look at the use of sanctions, this is something that was used to crippling effect in Syria. We created a 66% inflation. We created better than 100% inflation in Iran between 2012 and 2013, crippling their import capabilities and then ultimately cutting them out of the SWIFT system. The long-term ramifications here are actually dollar negative and U.S. negative, because what this does is it forces an Asian and a Russian workaround in terms of the way we settle accounts and transfer money internationally. There's two systems, the SWIFT system from New York and the SWIFT system through Brussels. And basically, we're communicating to the developing markets that if they are ever going to have any conflict with the West, whether that's Europe or the United States, they better have worked out some other means of transacting business, not through our normal financial channels. So I think you're going to see a dramatic acceleration away from the US dollar and a dramatic acceleration away from the backbone of what is our financial system in the West.
Well, David, now that prompts talk of a couple of things. When you're outlining this situation in terms of Russian oil and American oil, I'm sitting here thinking about the Chinese and the Japanese and the Asian sphere of influence as you just detailed it here. We know the Chinese are working deals with the Venezuelans. We know there's a substantial Chinese presence now in our own hemisphere. What do the Chinese do? Does this set up a redoubling of the effort to have the yuan replace the dollar as the standard currency? Or do you see the establishment of what was talked about a couple of years ago of a new standard, a quote, petrodollar that becomes reflective of world currencies and becomes the measuring device, if you will, in international finance?
Well, for currencies, there's sort of two uses, a currency as a reserve asset and a currency as serving a trade function. And we're already seeing an aggressive move towards the regional preeminence or the regional dominance of the yuan in the Asian space, if you will. So looking at bilateral trade agreements, the dozen or so that have been signed in the last 18 months, I think underscores they're retrofitting the plumbing, putting in new pipes, if you will. So that I think will be the case. They are not yet at a point where they can challenge the dollar in terms of reserve currency status, and that's a different role that our currency plays. But that could come on the heels of this.
Now, one other question. In terms of oil in the United States, new discoveries, are we going to see reserves eventually drive down oil prices perhaps to $75 a barrel? Do you see that happening? If that does happen, what does it mean?
Well, a couple of things. Very interesting point. We have ample supply in the market today. What is holding the price up are the geopolitical issues we've been discussing. And when you look at simply supply and demand, there's plenty of supply. And that would argue for lower prices in the future. That would be the most crippling thing that we could bring to the Russian space.
All right. Open up those markets, those discoveries. It changes everything. David McAlvany, we appreciate your insights as always.
All right. We'll be right back after this. Of course, you can always reach out to us on social media. We'll get to your comments at the end of the show here. You can find us on Twitter @NewsmaxTV, #AmericasForum.